Hello, everybody, and welcome to this event, this online event by the Hellenic Observatory. My name is Vassilis Monastiriotis. I'm the director here of the Hellenic Observatory, the Center for Research on Contemporary Greece and Cyprus at the LSE. And this event is part of a series of events that we have been organizing online on issues relating to growth and economic transformation in Greece, financial integration, and other topics. Our topic today is one of the hot topics of today. We're talking about the Recovery and Resilience Facility as it's coming to its completion in August this year, and our focus is from absorption to productivity. We want to explore the implementation issues and the best practices lessons that have come out from the implementation issues, but also on the big question, of course, of how and whether this fantastic innovation from the European Union under the Next Generation EU program of pooled common borrowing and supporting recovery and resilience in the member states, whether and how, to what extent it has successfully led to economic growth, increasing the well-being of the people across the European Union, but also in particular in Greece, which is, if you want, the case study of the event today. Now, to discuss this topic, we have an excellent panel with us. And we have our colleague, Professor Antonis Bartzokas, who will also open the event with a presentation on the topic, reflecting some work that has been done both here at the Hellenic Observatory, but also at the University of Athens, where he is affiliated. Let me start by introducing our speakers who will comment both on the presentation and the wider question on the RRF experience in the order that they will talk. Our first speaker will be Dr. Fay Makantasi, who is research director at diaNEOsis, a very well-known think tank in Greece. Dr. Makantasi has completed a PhD in economics at the Athens University of Economics and Business, specializing at game theoretic approach to international trade, but her areas of expertise expand well beyond international trade, and she's a regular commentator on economic and social policy issues in Greece in various policy forums. Our second speaker is Mr. Nikos Mantzoufas, who is associate partner at EY-Parthenon in Athens, leading the EU policies and access to EU funding and initiatives. He has more than 25 years of experience across government consulting, investment banking, and industry, specializing on EU funding, strategy, public-private partnerships, and so forth. He has previously served as governor of Greece's Recovery and Resilience Facility Agency, so he knows things well from the inside as well as from with and without, as we say, and he has led major financial initiatives with the European Commission, the European Bank for Reconstruction and Development, and global industry players. Our third speaker is Professor George Petrakos, who is professor at the Department of Planning and Regional Development at the University of Thessaly. Professor Petrakos has a long experience not only in academia but also in policy. He has served as Secretary General in the Ministry of Development in 2010-2012. He's been member of the Board of Directors of the Hellenic Development Bank, but also he's been expert with the European Research Council and Vice President of the European Regional Science Association. He's published widely on issues concerning not only regional development, but specifically also the use of EU funds, mainly cohesion funds, and the growth effects of their deployment. As I mentioned, the floor will open with my very good colleague, Professor Antonis Bartzokas, who is a professor of economics at the University of Athens, but also a research associate here at the Hellenic Observatory, and also the director of the International Economics and Development Laboratory at the University of Athens. After the presentation and the discussion by the speakers, we will have the opportunity to open the virtual floor to your questions for the participants. If you have a question, you can post it. Don't wait for the very end until you post your question. You can post it as we go along using the Q&A function that you should be able to see at the bottom of your of your screen. Okay, without further introductory remarks, I would like to pass the floor to Antonis Bartzokas.
Thank you, Vassilis. My role today is to provide a framework in the debate we're going to have. And I think I better keep it as short as possible because there are two interesting things in the timing of this event. One is that it happens in a very challenging time because we take stock of what happened and we see what is going next. And then we're very lucky to have a very distinguished panel with us bringing three different perspectives in the debate. So I will try to be very brief to give the floor to our distinguished speakers. So let's try to frame the debate. And I would say that, next slide, please. I would say that there are four interesting questions that we need to start, four interesting starting points. The first one is, to what extent RRF is different from previous instruments in cohesion policies. The second, what we have learned from the macroeconomic point of view from the implementation of this program through the years. The third is quite obvious. Greece has been a model case in this program because of the relative importance, but also because of the challenges. So it will be very interesting to discuss what we have learned from the point of view of performance-based new financial instruments for structural transformation in Europe. And finally, the fourth question is more forward-looking. I mean, what comes next? Is there an extension? Is there a streamlining? Is there a mainstreaming process? What is the next step? Next slide, please. I mean, the facts are well known to everybody. We know that this has been a massive program, that it has loans and grants combined, but I would like to stress a couple of interesting points. One thing is that now we have a debate about the extension, what is going to look like. Another point is that this is a series of instruments that is debt financed. And this debt repayment from the European point of view goes up to 2055. So financial sustainability is part of the equation, I would say. Next slide. Next slide, please. Now, I would like to stress an important issue for the debate. One thing is that there have been several macroeconomic models underlying the massive importance of the program, as you can see here, and they are solid and they provide, projections and interesting projections, but these are not facts. These are, what was expected ex ante in a way. Next slide. What is very interesting in our debate is that apart from, say, macroeconomic modeling for the RRF, because of the accountability issue, we have seen a number of in-depth evaluation studies, both commissioned by the European Union and the European Commission, but also from other bodies. And there we have very interesting insights about the substance of the program. Insights like, what happens when a program is performance-related and not cost-related. What happens when you have benchmarks and you have difficulty in assessing these benchmarks. And these background evaluation studies provide interesting challenges for the way we see and assess this program. Next slide, please. One thing that is a kind of common denominator in this debate is the importance of spillovers from this program. There have been several studies about spillovers. I mean, I share one chart with the findings of one of these studies, and it's very clear that spillovers have been very strong. But at the same time, if you look at Greece or other Southern European countries, you can observe that the asymmetry of spillovers is quite important. And this is something that we need to keep in mind. Next slide, please. An interesting point that perhaps George Petrakos will comment in more detail is how RRF is compared with cohesion policy. And it is very clear that the design was different, the scope was different, the rationale was different, and this is reflected in the way each one of these programs is developed, designed, and implemented. what we have done here, and this is also to the benefit of the speakers, is we have a structured, distinguished comparison between the two programs, in different settings, and it's quite important. Next slide, please. There have been. Next slide, please. Yeah, not the other one. Yes, there have been several studies on assessing the RRF as it evolved. And what we have summarized here is the strengths, weaknesses, and design tensions. And it is interesting to observe that, when it comes to strengths, the innovative nature of the program is underlined. When it comes to weaknesses, the way this program is interacting with other objectives in the European context is underlined. And when it comes to design tensions, the challenge is how we can streamline what we learned from this program going forward in a way. Next slide. Now, let's come to Greece, because it is very clear that Greece has been, say, a unique case study from two perspectives. One is the relative importance of this program. A second one is with the point of time in the business cycle for the Greek economy. You can see here how important the program is for Greece in terms of, GDP percentage. And then we will talk about, how important it has been for the business cycle of the Greek economy. Next slide. Here is the point about how all this is linked with the trajectory of the Greek economy. Because the background is that Greece was exiting a crisis. There was a serious funding gap for the Greek economy, but there was also a steep decline of productivity. So the question mark is to what extent a program which is well defined in terms of resilience can also incorporate objectives like enhancing productivity for the Greek economy. And our challenge to the speakers is how all this is related to the hysteresis literature, which is, developing right now, and how all this is related to the first facts we have already about, to what extent this program is contributing to the productivity of the Greek economy. It's an open question for our panel. Next slide, please. What we have done here is, a kind of stock taking of the current debate in Europe. We have seen what has been the scale and scope of the RRF. There are lessons learned, and then the question is, what is the agenda going forward? Apart from the issue of the extension, which is a kind of tactical issue, there are important issues about lessons learned and how they will be incorporated in the European decision-making process. There are different schools of thoughts. There are people who are concerned about conditionalities. There are people who are concerned about efficiency, and it will be interesting to see what kind of lessons our panel can share with us on this program. Final slide. So we kind of reflected on what needs to be discussed, and we came up with 5 core questions for our panelists. It is very interesting that we have core questions and we have 3 different perspectives. We have a policymaker, we have an academic, and we have a think tank, a think tank colleague giving us the forward-looking perspective. What are the questions? The questions are, what were the binding constraints for the Greek economy for the implementation of the RRF? Second question, going back to the core issue about productivity, to what extent this massive implementation of an injection of funding and grants and loans really shifted the direction of the Greek economy from extensive growth to quality growth and productivity, and then what kind of future planning can be implemented on the basis of capacity building that took place for the implementation of RRF. And then we have 2 generic questions about what comes next in terms of extension, and what comes next in terms of mainstreaming and streamlining the experience that we learned from the RRF so far. As I said before, we are very lucky to have 3 different perspectives on these questions and others that will be raised. And with that, I'll pass the floor to Vassilis. Thank you, Vassilis.
Thank you, Anthony, and thanks for this wholesome presentation. Indeed, the questions are many. I want to pass on the floor now to Fay Makantasi, who will talk on the experience. I just want to notice something looking at the big list of projects and reforms in the RRF, and the reforms range from things like the dentist pass, which is preventive dental care for 6 to 12-year-olds, to the digitalization of the justice system. So from the very small, not unimportant, to the colossal, I think. So over the floor to you, Fay.
Thank you, Vassilis, for the welcome and the introduction, firstly. And I would like to thank also Professor Bartzokas, dear Anthony, for the kind invitation and for organizing this very timely, discussion. Let me start after Andonis set the scene very effectively for our discussion. Let me start by sharing a few initial thoughts. At the beginning of 2023, when we were discussing the RRF, we rightly saw it as a historic opportunity for the Greek economy. It came after 12 years of severe underinvestment, during which Greece lost a significant amount on fixed capital. Now, I think that estimated at around 88 billion euros. That's why we said the RRF wasn't just another funding program, but a mechanism that could drive not only recovery, but also deeper productive restructuring of the economy. To put it differently, it was not just about returning to the pre-crisis situation, but about moving to a new, more productive model with stronger qualitative characteristics than the previous one. To put it in parentheses, when discussing the productive model, I'm thinking of living in Marmotas Day. I don't know the exact expression in English, but that's
Day.
Okay, that's correct. Yeah, thank you, Vassilis. And indeed, that expectation wasn't exaggerated. The scale of the resources involved was very large for an economy like Greece's. To date, the country has received 24.6 billion euros, about 68.5% of its total allocation, and has met 53% of the milestones and targets set out in its national plan, according to the site of Greece 0.2 Gov.gr. So this is clearly not a program that remained on paper. It was genuinely activated, it influenced public policy, and it mobilized significant resources. So the real question is not whether it was activated, but whether it was used in the most effective way, given that the Greek economy actually needs higher productivity, a shift in the production model, a restructuring of its economic base generally. And here, in my view, the answer is considerably less triumphant than it's often presented. First, a significant share of the resources wasn't invested in actions with a strong productive or developmental footprint impact. I'm not saying these actions were useless or socially unimportant. What I mean is that they are not the same as investments that clearly increase the country's stock of productive capital and strengthen the economy's long-term productive capacity, even after the RRF expires. Some characteristic examples are the financing of pending surgeries from the waiting list, including afternoon operation and procedures carried out in private clinics. The program Stay 2, My Home 2, which directs around 1 billion euros of RRF funds into loans for buying first homes rather than building them. The large reskilling programs in sectors like tourism and broader horizontal expenditures on publicity, on technical assistance and implementation support. All these interventions may have their own logic and to some extent may even have been necessary, but they cannot really be considered investment uses of the available resources. Second, a largely horizontal approach was adopted, especially in the area of digital transition, as you mentioned earlier, Vassilis. The European Commission itself describes the Greek plan as a broad effort to digitalize public administration, public healthcare, education, connectivity, digital skills. On the surface, that sounds very positive. The problem is that when resources are spread across dozens of fragmented projects, things like vouchers, like many management systems, various support structures, what you get into a critical mass of investment in strategic sectors that could create or strengthen comparative advantages. In that sense, the RRF functioned more as a mechanism for generally boosting investment and spending than a tool for a strategic redirecting the economy. Of course, higher demand does have a positive short-term effect on economic activity, and naturally we cannot pick and choose every investment, but the Greek economy suffers not only from low productivity, investment gaps, and weaknesses in technology and innovation. It also faces deeper structural problems that require much more targeted investment choices if they are to be addressed effectively. Third, the quality of the implementation wasn't really in line with the historic scale of the challenge. The European Commission itself in the 2025 country report for Greece explicitly noted that a significant acceleration would be needed for Greece to meet its commitments by August 2026. It pointed to key bottlenecks such as lengthy judicial procedures in public procurement appeals, delays in property right transfers, weak coordination, especially in projects involving more than one ministry. On the other hand, the risk of significant crowding out of private investment by public investment in an economy that at the time and arguably still today doesn't offer abundant investment opportunities was largely mitigated by the way the loan component of the RRF was designed and used. These loan resources were channeled exclusively into supporting and leveraging private sector initiatives, which meant they reinforced rather than competed with private investment. In this way, private incentives remained aligned, while banks and financial institutions undertook the evaluation of business plan. At the same time, the state didn't increase its net public borrowing. Of course, this choice also had drawbacks, the most important being that economic actors with limited access to the financial system were effectively excluded from the loan resources, either because of small or informal somehow scale or because of previous insolvency. Nevertheless, I believe that the advantages of this strategy clearly outweighed its disadvantages. Before moving to an overall assessment of the program's impact of the Greek economy, I would also like to make a brief comment on the very interesting presentation Antonis made.
Just in a 1 minute, Fay, if you may, because we'll come back to this anyway.
Okay, there is a paper mentioned by Bankovsky in a slides et al. So overall the effect remains positive of the RRF. But it appears more limited in size. It's around 0.4 to 0.9 by 2026 and 0.8% to 1.2% by 2031. This revision is attributed to implementation delays, of course. So overall, the effect remains positive. It appears more limited in size, more long-term in nature, and significantly more dependent on implementation quality that initially assumed. So if I had to summarize my overall assessment in a single sentence, I would say that despite its weaknesses, despite a less than optimal design, and despite an even more questionable quality of implementation, the RRF has had a clearly positive impact on the Greek economy. However, it doesn't seem, at least so far, to have served as the launchpad the country needed in order to shift onto a path of rapid and sustainable growth beyond the duration of the program itself. So, if it is, okay, I'm almost out of time. I understand. So I'll get back to some questions in a bit more detail later.
Thank you, Fay. That was very, very useful, and indeed we'll come back to this. It's interesting to see there's parts of the Commission that are very enthusiastic about the implementation of the RRF in Greece, and there's other parts, perhaps also in the Commission, but other parts of the world where there's many questions, and some of these questions you brought up in a very organized, I felt, in a very organized way. So we're passing on to Nikos Mantzoufas, who is partly responsible for some of this. So looking forward to hearing his comments. Nico.
Thanks, Vassilis, Andoni, and all the rest. Thanks for being here, and really happy to participate in this very interesting debate. First of all, I take blame for everything that is wrong, so feel free to judge me. But let me start giving you a perspective of how all this started, because it's very interesting when we are making any kind of assessment to understand how things started, what was the timeline under which things had to be implemented, and also draw a comparison of what is happening to other EU member states, which is very important so as to get and have a global perspective of, at the end of the day, the result that have been there. To start with, I had a quite deep private sector experience, but for the last, since 2009, I had been Secretary Special for Public-Private Partnerships, and I was within this type of positions within the public sector for 11 years. So knowing the Greek administration very, very well, the capabilities, the limitations, and also during the crisis period. So having that 10-year experience within the public, I assumed the role of being the first governor of the Recovery and Resilience Facility in Greece, where we started from a blank paper, literally. So we had day one to set up the law, to set up the administration system, to set up the control and audit mechanisms, to design a plan that has been thoroughly reviewed by the European Commission, and after all that, to actually coordinate and have to draft more than 300 milestones and targets, and to start the implementation of this really unique program. If someone believes that this is an easy task, I assume nobody is believing that. That was really one of the most challenging tasks I haven't, I think, ever in Greece had been done. So to start, we had a zero staff administration that we did set up at the Ministry of Finance, a dedicated central unit, allocating 40 people coming from different departments of the public sector. And this is one first point. We designed and we structured a central team that is unique in nature, meaning many different disciplines, many different experiences, and all this bringing a new way of thinking, a new way of implementation at that central level. Now, you understand very well that having a good, strong, solid, experienced, coherent central team does not necessarily mean that this can be easily spilled over to the number of ministries and administrations. That was really a huge task. Second thing that sometimes we don't take into account, we did build up a very rigid control and audit system. We had numerous discussions with the European Commission so as to set up this type of control and auditing mechanism. And all these are adding delays, definitely. But at the same time, they structure a well-run, in my opinion, program. By the way, we were one of the first countries to actually get approved the holistic plan. We were the first country where the control and audit system was assessed and reviewed and approved by the European Commission. And so far, we are one of the first countries in regards to the absorption of the EU funds. Now, can one say that everything was perfect, everything worked in a way that we originally had designed? The answer is no. But a real answer on that is that there have been many good legacy issues that will definitely help the public administration going forward. And a very important element is in regards to what will be the impact. This is something that we will see it in a couple of years. We are in an era of continuous shocks, war, energy shock now. So all these reforms that are taking place cannot be easily be seen on the transformation of the Greek economy. Already in some areas we do see it. So I would say that in a couple of years we might take a view to see the real impact. It's a bit early to make the assessment right here, right now. I would like to stick to one particular example, and it's right from the start we wanted not to crowd out private investments. And indeed, the majority of the public funding was towards the public investments. Yes, there were some vouchers, many vouchers, schemes that were necessary in a way, but one needs also to take into account on the public absorption the real capacity of the administration. One could say, I would like to build everything, but not having environmental studies or approvals yet, having the appeals. All these are systemic, and not only in Greece. If you take a closer look on how the public investments in all the other EU member states take, I would dare to say that Greece has performed relatively better than many other European member states. And this is something across the European Union, how to streamline and faster all the investments through the various administrative and approval processes that are in place. For a good reason they are in place, but definitely they delay things. So we couldn't actually absorb more within a very specific period. So it was only 5 years. 5 years is really a really small period for someone to say, I want everything to be on aspiration projects that transform the public sector. So there was a mix. That was on the public side investments. Now, I need to mention also, it was mentioned by Fay, the design of the RRF loan facility. In Greece, right from the start, we took the decision to take all the available loan facility that we could undertake, 12.7 billion euro, and 100% of it to channel it towards private investments. And that was under 3 pillars. One was the pillar of the private investments, where we were to provide 50% of the total investment cost at the suboptimal interest rate, but without any guarantee by the state. A reason for that was that we couldn't afford to take on balance sheet this part of the debt. That was very clear also from the European Commission and the institutions. So no bank guarantee there. We are providing lower interest rate than the commercial one towards the market for 50% of the capex, having equity participation and banks. How this particular program worked? First of all, we mobilized all the Greek banks, one thing, but beyond that, it was also EBRD and DIB that were implementers of that particular program. So far, we have more than 700 projects that have signed these loan agreements, undertaking more than 11 billion of RRF loans on a 25 billion investment program. These projects, and this is a peculiarity of the RRF loan facility, the design, do not end by August 2026. By the August 2026, the signing of these loan agreements have to take place. So all these most of these 25 billion investments, private investments, will be spent over the next 1 to 3 years. And in there, we will see a real impact that currently no study is actually considering what will be the effect of this massive investment program across many sectors, many of which are at the manufacturing sector. It was a very good surprise to see many manufacturing companies actually undertaking this initiative and this opportunity, having a lower funding cost that was really needed for the Greek economy and the Greek enterprises to undertake that program. This particular product is characterized not by us, by the European Commission and any institution that is reviewing that particular program as a unique, a total transparent instrument. The government was not taking place the position to select, I want Fay, Vassilis, Adoni to take that loan. No, that was on the banks on a very transparent way with no appeal, and many reviews from the European Commission on the control and audit and the effectiveness of that particular element, given that in Europe it was the single one biggest measure that ever was undertaken. But one would say, okay, what about the ones that do not have access to the banks? Was it that program for them? The answer is no, that was not for them, that's for sure. But as I said, we do need good projects, good companies with investment capacity to undertake major investments at a global scale, at a European scale. This is seriously needed in Greece, and I think that part served this. But we also structured for the smaller...
Nico, if I may interrupt, if you can wrap up in a minute, Max.
Yes, just a minute. But was that the only program? No, because especially for the ones that had not that easy access to the banks, we structured a 600 million program, a guarantee program. So we took 600 million for that under the InvestEU channel through the banks, EIB, BRD, all of them, as providing the guarantee. And that means we are taking that part as part of the debt. But very, very thoroughly, we undertook that decision so as to serve also this type of companies. And already there are some thousands of companies that had utilized this guarantee scheme under the InvestEU. And the third element is that we did structure a 600 million program for equity investments under the Development Bank. So through this loan facility, we mainly focused on bringing more funding opportunities, less cost to the extrovert enterprises, but we also took care about the ones that didn't have that capacity with that guarantee, and also to the ones that needed equity. Also, that has worked. All in all, certainly, my opinion, even though I have served only for 3 years, the first 3 years, my view is that the outcome is quite positive, both on the implementation and the structural side of the public administration, a very different mentality, many things to learn, many thousand things to learn and improve, and many of these results remains to be seen over the next years. And the final comment about the future of the European Union funding, etc. I'm strongly in favor of large envelopes being centrally managed by the European Commission. Certainly national envelopes, no doubt, but I'm strongly in favor of big envelopes under the central management of the European Commission, like the Innovation Fund, like the Connecting Europe Facility, and the one to come, the Competitiveness Fund. Europe needs to be a one entity and not the sum of a number of countries, but acting as a key player and structuring key central instruments. Thank you, Vassilis, and happy to go further on any topic you think.
Nico, thank you so much. It's so much vast experience with the project, so we could have you here for hours to tell us all very nitty-gritty details. One lesson is that managing the micro details of the program is anything but straightforward. So definitely important. But I think your last comment also passes the floor to Giorgos Petrakos about both the European effort in terms of the funds, but also the degree of centralization of the in the management of the fund at the national level and what happens to the regions. I think these are things that Giorgos Petrakos will definitely touch upon. Giorgos, the floor is yours.
Thank you very much, Vassilis. It's very nice to be here and join this panel and have the opportunity to present some of my thoughts and some ideas about the RRF. I will make some comments first about planning, the way RRF was planned, and then implementation, impact, and at the end, I will make some suggestions about the way ahead. Next, please. First of all, knowing the experience of the NSRF, they should have planned for a longer implementation period, and I'm talking about the European Commission. 5 years is not clearly enough for a program which is much bigger than the NSRF, and this is one of the reasons that it is difficult to be implemented in time. The second point is that centralized planning has improved absorption, but this is rather marginal compared to the NSRF. However, this has taken place at the expense of limited public consultation, consensus, and stakeholder participation, which was a standard practice with NSRF, either at the national or at the regional level. one issue of concern is that in comparison with an NSRF, RRF provides very limited official information about the projects that have been financed and their sectoral or regional allocation. So it is difficult to monitor how the whole program is progressing, but also the details of the implementation. In any case, centralized or less centralized method, the point is that we have the same delays in implementation as the key administrative bottlenecks and the built-up bureaucracies remain intact. I refer to the public procurement process, to endless procedures in environmental permits, urban planning, land use change, and long delays in the juridical system. To change land use in Greece or to prepare an urban plan might take more than 3 or 4 years, and this is something that takes place for a long time. An issue of concern with RRF is that it does not include specific regional targets, which means that the allocation of funds will most likely increase the regional inequalities. Finally, a comment on planning, last comment on planning, is that on the one hand, the Draghi report, and the other hand, the multiple crises that we have lived after the pandemic suggest that this type of interventions need to evolve from one-off to a permanent facility embedded in the multi-annual financial framework. Next, please. Now, implementation. We have information from 2 sources, and those are limited. First one is the Commission, the diagram you see at the bottom, and the second one is from the Ministry of Finance, from Public Investment, which provides the figures by the figures for RRF by minister. The country has received 23 billions, which is 65% of the total, but by April, it has absorbed only 54 from that amount, which is only 13 billions. As a result, the absorption rate of the total funds is 37% in this year. This is a low level of absorption, and of course, it's not something that happens only in Greece. It happens everywhere in Europe. That's why I said 5 years. It's not enough for the level of funding, and as a result, it's certain now that a part of the funds will not be absorbed. Now, in terms of sectoral distribution, it seems that almost 60% of the funds have been allocated to environmental, energy, and digital infrastructure projects and investment, while a small share, not easy to identify it exactly, but not more than 6% has been allocated to manufacturing. Also, a large share of the loans has been provided to a few large corporations, despite the fact that they already had easy access to credit. Next, please. Now, the impact. For sure, RRF has contributed to employment and GDP growth, although the multiplier effect of public investment is weak. Antonis mentioned that in his presentation. A simple calculation of the increase in public funds in the 1925 period which is 36 million, and a comparison with the increase in real GDP, which is 26 billion, shows that the multiplier effect is very weak. And this is basically because a significant part of the public spending is transmitted through imports to advanced EU and global economies and not to domestic production, which remains weak and fragmented. Now, if you look at the diagram, which is the evolution of GDP per capita in Greece and the European Union, you will see that of course, a positive trend in Greece, but also a positive trend in the European Union. But you will not see a trend change, at least not a visible one. Nikos said that we'll see some of the effects of the program in the coming years, which is correct. But at the point, this is not visible. So what is the impact? Like I said, there is some impact on growth, of course, and also some impact on employment. In macroeconomic terms, this is weak. In terms of structural change, I will make the prediction that RRF will modernize the existing model of production, which is dominated by construction, energy, tourism, and real estate, by making it greener and to some extent smarter, especially in the public sector. Greener in the sense of interventions in the energy sector. However, my feeling is that RRF did not change the production model in any significant way, as the impact on manufacturing, R&D, the knowledge economy are very weak. And as a result, the impact on the competitiveness of the smaller firms is limited. Keep in mind that the smaller firms of the economy are the backbone of economic activity in most of the regions of the country. And those are, and they have a very significant contribution to employment. For example, in industry, we have less than 500 large firms with more than 250 employment, and we have more than 50,000 small firms with less than 9 employees. Next, please.
Giorgio, if we can wrap up in the next minute, if possible.
Next minute, impossible. Now,
okay, 2 minutes.
Give me a couple more minutes. The development model. What is the development model? It's weak. Manufacturing remains weak. 8 or 9% GDP. 90% of manufacturing firms are small. Investment is at 15% of GDP. At the European Union level is 25%. Business R&D is the third lowest in the European Union. FDI stock is the second lowest in the European Union. Even that stock is in finance, retail, and real estate, and only 14% in energy, and 65% of exports is in agricultural products, raw materials, labor, and low technology intensive sector. That's the development model. My feeling is that the impact on this model has been very weak, and this model is complemented by weak institutions and deficits in the rule of law, and also significant regional gaps. Next, please. 2 more slides. In my view, we live in a period of strategic trade by the major trade partners of the European Union, declining global competitiveness, and significant geopolitical shifts. So the European Union needs to strengthen its policy arm and make it more effective. Therefore, it needs a permanent investment instrument in line with the Draghi report, which will support the European strategy for reindustrialization and global leadership. This should be in complementary to the cohesion policy and agricultural policy, and should mobilize additional public resources in order to close the investment and technological gap. Besides the funding, this requires also the re-examination of the EU competition regulations, especially those about state aid, and an overall simpler and more flexible institutional framework. Next, please. Finally, for Greece, I think the future program, the future RRF program should have a clear focus on the production model, which means prioritize investment in manufacturing, and especially in knowledge-intensive sectors and technologies, provide R&D, but strong support to R&D, putting in the same room the science base and the industrial base of the country, develop strategies supporting domestic production networks and participation in European and global value chains, and finally, implement deeper reforms, building credible institutions and strengthening the rule of law and the quality of governance. Thank you very much.
Thank you, Yorgo. Again, too many things to say, too little time as always. I was planning to ask you a couple of my questions before we open it up to the questions from the audience, but I think we touched upon, all presentations touched upon one very central issue, and already a couple of the questions that we have relate to that issue about the directionality of growth, the growth model of Greece, if you want intensive versus extensive growth. Are there enough spillovers? Maybe some businesses, and especially large businesses, were supported. But what about the transformation of the Greek economy and of course, the increase in productivity? Paris Georgoudis in our Q&A has raised this issue that comparatively less appears to have gone towards the secondary value, the manufacturing sector, where Greece lags in productivity. More money, we also in the presentations went to energy and environmental interventions, maybe also to tourism, I would add. And then there's another question by Phyllis Papadavid from the ODI Global Think Tank, where he raises, asks the panelists to discuss the scope for the RRF to promote a new transformative growth model. So yes, to higher productivity, but also broader diversification of the Greek economy, and of course, development of sectors that are lagging in the Greek economy. So all this idea about not only, quality growth, so extensive growth, productivity growth, but also the directionality of growth and the Greek growth model. Can I start with Nikos, if I may, and then I'll pass on the floor to Fay and then Yorgos on that.
Yes. I think we need to have another such a debate and several kind of studies in 3 years' time. It's it's really early for one to say how the RRF really impacted the Greek economy. I take a note from George earlier, and I echo this point. Definitely, it has changed a lot the public administration. It has reduced a lot of bureaucracy, digitalizing many things, many more to come. But all these digitalization programs will actually be seen and become effective the next years. So a challenge to see what will be actually the impact in the near future, not in the longer run. Now, one point in regards to the growth model. Okay, in my view, the growth model you can subsidize, you can support, but at the end of the day, it's the dynamics of the market that dictate the growth model of an economy. I don't believe, regardless of how much money you pour into a specific sector, that this will survive or thrive or become a regional, European, global leader if many other fundamentals of the economy are not there. So we need to have that in mind. We need to understand what is the starting base for manufacturing, for instance, in Greece. And considering that, my personal opinion is that definitely it has supported a lot towards that end, not becoming the manufacturing engine of Europe. I doubt if this will ever be the case, but definitely in specific sectors, scaling up. For instance, we have company that is a global leader in cables making. These are expanding their production facilities, taking advantage of the cheap loans of the RRF. And there are a number of, out of these 700 I mentioned, companies that utilized that particular envelope, most of them being on the manufacturing, not tourism, but manufacturing, no retail, but manufacturing. So it was mainly energy and manufacturing, the beneficiaries, because of the market dynamics, yes, one thing, and by us offering a very fast, very transparent, and providing lower interest rate to these facilities, to these companies to expand their facilities and capabilities. I'm really optimistic, again, that in 2-3 years' time, we will see this gradual change taking place.
Thank you, Nico. I'm curious to see how much agreement or disagreement there is on this. Fay, can I ask you to take the floor, and then I would like to also ask Anthony and then Yorgos all the views on that.
Thank you, Vassilis. As I mentioned earlier, the Greek RRP was likely too broad in scope to bring about any significant transformation of the production and development model in Greece. So it is clear that the preference was to focus on general sectors that could have a supportive and multiplier effect on all economic activities. This is not necessarily wrong. There is a rationale for it, but there is also an opportunity cost. From a program of enormous scope, almost no resources were allocated to the absolutely essential goal of redirecting the Greek economy toward appropriate sectors and industries where there are active or potential comparative advantage, or where there is a strategic reason to obtain a critical mass of investment. So as far as your question concerned about if we have an extensive or an intensive growth, in my view, the evolution of Greece's macroeconomic aggregates in recent years suggests that what we are observing is, to say to a large extent, a case of extensive rather than intensive growth. To put it differently, growth has been driven primarily by the expansion of inputs rather by a genuine improvement in total factor productivity, in technological upgrading or higher output per unit of input. Instead, the main sources of expansion appear to be the reduction in unemployment combined with an increase in labor force participation, the reactivation of previously idle productive capacity, particularly through not exclusive in the housing and building stock, and more recently an increase in the stock of physical capital. So that said, for an economy emerging from a deep adjustment process, the initial phase of recovery is almost inevitably extensive. Labor is reactivated as its values rises, capital utilization increases, and previously frozen investments are unlocked. But this extensive phase is inherently limited. We are already approaching the natural limits of labor absorption. There is still more room on the capital side as we remain below the long-run equilibrium capital stock, or at least we hope we do. But as a convergence continues, the pace of expansion will naturally slow.
Thanks, Fay. And I guess we're not yet at the point where we exhaust the intensive margin and leading to huge inflationary pressures, but the point is, of course, well made that you need extensive growth and not only relying on inputs. Anthony, I would like to pass on the floor to you for some thoughts.
Thank you, Vassilis. I'll take a minute to reflect on this fascinating debate we're having and what it implies for the policy debate in Greece. I mean, we hear from Fay that when it comes to that level of ambition, that kind of programs, you need to have a holistic approach in the way you assess and the way you design your next steps in a way. And this is very important. From Nikos, I get a very interesting comment, which is that Greece was exiting the crisis. There was a huge investment gap in the country, and there wasn't a well-structured mechanism to guide the process for investment recovery. And that started with RRF, with all the difficulties and the delays that Nikos is underlining. From George, what I hear is that it is very difficult to have a top-down optimal path for growth when you have structural weaknesses. But at the same time, he is semi-optimistic because he thinks that when it comes to the current context, we have European challenges that might facilitate a better investment coordination. I think all three are very important messages for the policy debate in Greece. Thank you, Vassilis.
Thank you, Andoni. And George, would you like to, I mean, you covered a lot of that in your presentation, but if you'd like to say something about this idea of whether the RRF missed the opportunity to lead to diversification and kind of transformation of the productive model, or whether it has been successful or shouldn't worry about it. You know?
Well, in bullets, first, we need more time. I agree with that, and we should need more time in implementing the program. If we had that, some of the decisions of the last minute would have been avoided, and more strategic objectives and long-term objectives would have perhaps been selected. Now, what we need to do is develop value chains in tradable sectors. Otherwise, we don't have a growth model. We always reproduce the same thing we have: construction, tourism, real estate, plus energy this time. I'm not downplaying or underestimating the energy sector, but it's not. It has two disadvantages. First, it's not creating value chains in the economy. Everything is important. Every time we expand the energy sector, we also expand the trade deficit. So there are no spillovers, there are no that kind of effects in the economy. No value change. Second, it's a question whether it is a tradable sector or not. So far, it works more on domestic demand. It has an oligopoly structure, and the statistics say that compared to our income, we're paying relatively high prices for energy. One more point is that the state should have a strategy. I don't think that the market should decide which way the economy should go. It's the state as a representative of the people that should have a strategy, and this strategy has been already decided at the European Union. I mean, there is a consensus about the reindustrialization of Europe, and should be a consensus also for the same objective in Greece. That means that if we want to change the model, we have to emphasize on industry. Now, in industry, the figures are very specific. We have about 500 large firms, and then we have 50,000 small firms. What we are going to do about them? They are the backbone of the economy. I don't see any specific or significant support framework. And I don't think that the bank should decide whether they will be financed, how they will be financed, and whether the business plans will be accepted or rejected. This should be part of a national strategy that deals with the structural problems of the economy.
Right. This is a big debate also in the international literature, so I would like to get Nikos' view on that. I think he also wants to chip in.
Thank you. 2 points. First, on the energy sector, just to give an example, energy sector is also the interconnection of the islands, meaning interconnecting mainland with the islands with subsea cables. Good. Is this imported? The answer is no. In Greece, we have a global leader in cable making, and we have a global leader from the shipping industry on actually putting the cables under the sea. So having a large interconnection program that was heavily supported also by RRF and expanded heavily, this created some leaders that are totally global leaders in their market. So it is not 100% correct that focusing on the energy sector, we do focus only to imports, and we are not boosting our productivity and our economy. And a final point in regards to who is shaping the direction. Okay, at the end of the day, it is a mix, but a strategy should be there, yes, a focus on where you're providing subsidies, yes, but I wouldn't be in the position saying that it is the state officials that would take these kind of decisions. We have faced in the past many bad decisions on that, many bankruptcies out of this bad decision. So a mix of strategy and professional judgment, to me, is the right mix to support also the smaller scale companies.
And if I may add shortly, it would be extremely useful to have more detailed data, not only on the sources that went into private sector initiatives, but also on public investments. there is a lack of data to support our views.
Thank you, Fay. That's also a question from also a good colleague, Alexandros Kontonikas, who says the scientific evaluation perspective, we need the data and the micro data in order to be able to do this analysis. I should also say that taking the opportunity that here at the Observatory, we try to do also not only the impact assessment, but also try to understand what is the functional allocation of funds, as we do and have done with cohesion funds, but also with state aid falling outside the RRF. And it is an important barrier. Without data, you cannot have how much you can contribute to the public debate is limited by the data, and that's a missed opportunity. We will run out of time, I'm sure, but I would like to shift the discussion a bit more to the governance structure with the European dimension, if I may, inspired, if you want, by a question asked by Dimitris Papadimitriou, who says, well, his question is, and please, I will ask the panel to address it, but I will add my question to it. So Dimitris' question is the centralized nature of designing and implementing Greece's RRF plan a case of Greek exceptionalism, or it can be witnessed in other EU member states? So is the degree of centralization of how the RRF was run unique to Greece, or is it kind of common across? Before you attempt this question, I would like also to ask whether, in your opinion, this kind of centralized governance structure that the RRF has compared to cohesion and structural funds suits Greece better or not. In the international literature and policy making, the high-level group on cohesion policy was saying that we shouldn't take away the regions and centralize everything to the member state level. But obviously that may work better in some countries and not in other countries. So is Greek exceptional in terms of the degree of how centralized the management of the funds was? And does that work for Greece more or less compared to other more decentralized models like the structural funds? Who would like to come in?
May I start? This is universal. And one of the key reasons was the very limited time for implementation. Really limited time. The 5 years is really a breath. So all the EU member states adopted a centralized model. Now, is it better or worse? Okay, I will not get into that debate, given that we couldn't do differently. But in general, I do support that also regional governance in next instrument should be part of the decision making, for sure.
Thanks. Yo?
Yeah. First of all, if you look at the structural funds and compare the national programs with the regional programs, you will see that there is no difference in absorption or implementation. So there is not an issue of weaknesses at the regional level in implementing the programs. It is an issue of bureaucratic procedures that are related, especially with the implementation, that put obstacles in both national and regional programs. So now the critical issue is not the level of implementation. The critical issue is consultation. The critical issue is stakeholders. The critical issue is democratic legitimacy. Whether such a big investment program that appears once in a century has been implemented in a way that meets the key priorities of the economy. So I think this is what we have to focus, and rather than who is having the management.
Fay.
Okay. I think that the main lesson we should take away is that careful planning and front-loaded implementations are essential for the success of any program. So we still do not know what exactly will follow the next generation EU framework, but whatever comes next, whether we are talking about future EU instruments more generally, or programs such as cohesion policy or the CAP, we need to be fully realistic about the projects, the actions, and reforms we include in our planning. And realism here is not only about whether something is theoretically feasible, but also about timing and project maturity. For example, whether the necessary studies, the permits, and preparatory work are already in place. Second is, it is clear that the European institutions are moving increasingly toward a payment by results, or at least by output rather by input approach. So we are all familiar with the criticism raised by the European Court of Auditors as to whether the RRF can truly be considered result-oriented. This makes it even more important to estimate correctly not only how long a project or reform will take to implement, but also how long it will take before we actually see measurable results. So in that sense, implementation needs to be designed in a much more aggressively front-loaded way. And finally, a lesson and a more open question is how desirable is it for most interventions to remain largely horizontal in the future. On the one hand, horizontal projects and policies help limit the distortion that can arise from the European intervention. But on the other hand, they may fail to provide the strategic focus that could be necessarily in certain sectors, where actually creating a critical mass and generate much stronger multiplier effects. This is not an easy question, not only for Greece, but more broadly in the long-standing debate on economic policy in European Union. So at this stage, however, the reports of Letta and Draghi seem to point increasingly toward the need for some form of European, but also national industrial policy.
Right. I think we're coming close to the end. We have another question from Dimitris Sotiropoulos, who, however, I think he left the room. I think we answered it. The absorption rate would be somewhere between the 37% that George Petrakos mentioned and closer to, I would imagine, 70 plus if we allow for all the loans to be taken out, as Nikos Mantzoufas was mentioning. As well. There is also a question of will there be an extension to the program? I'm aware that there's a proposal by the European Parliament to extend. The Commission is not super supportive at the moment. If any of you has any inside information on this, please share it with us. Otherwise, before we say our goodbyes, I would like to pass the floor to Adonis for a couple of minutes to tell us a bit, again, a bit of a summary, but also what in his view, also coming from the development bank sector in some way, is the next step and the next kind of the next part of the debate for Greece in this context that we've been discussing.
Vassilis, on these two questions, it's not inside, it's very official. No, there will not be an extension period. And a point on the real absorption rate, even though I'm not the governor anymore for the last almost 3 years, I think it will be much higher than the figures mentioned before, and it could be quite close to the top absorption. That is my feeling.
Hopefully. One point that I have seen from the discussion in the internet is that projects right now run faster than investment. So that's one point. But at the other hand, what Nikos said is also correct. What is important is to have a signed loan, or to be an investment to be included in the program, and then flows will continue after July 26. So hopefully they will manage to sign as many loans by that time as possible.
Thank you. Anthony?
Vassili, I just wanted to take a minute to advertise our September conference, which is about growth drivers for the Greek economy. And it will be in the same spirit of pluralism and analytical depth like this meeting. And several Greek universities will be participating, also international speakers. The Observatory will be there, so the audience is very welcome to join us. And more answers to questions that were raised today might be addressed.
Yeah.
Thank you.
This will be, thank you to all. Let me then also do my closing remarks. This will be an in-person event in September in Athens, hosted by and organized by the University of Athens. In the meantime, before that, if you are in Athens, our next event is in Athens on the 28th of May, if I'm not wrong. Yes, 28th of May, Thursday, at 7 p.m. at the Central Building of the University of Athens, the Propyla Building in Panepistimou. We have a lecture by former LSE colleague Simone Iamarino, who just the other day got appointed as fellow of the the Regional Science Association International Association. Anyway, Simone Iamarino will be talking about critical raw materials in the EU, also raising another issue which is very important. We just, kind of concluding, we mentioned the significance of the potential, so the importance of industrial policy in steering the economy and ensuring there is not only competitiveness but good specializations. And the debate about, of course, critical raw materials and strategic autonomy is a big one. That's on the 28th of May in Athens. Then in London on the 9th of June, if you're London-based, we have again an in-person event looking at Cyprus, new prospects and old challenges for the resumption of talks, where we're talking about politics, economics, and society. So we bring everything together. Feel free to visit our website at the Hellenic Observatory and see which events you can join. Thank you all for participating. Thank you to our panel for the excellent and very thoughtful contributions. There will be a report, an update coming on this from the Hellenic Observatory. In the audience, stay tuned, but also with the colleagues, looking forward to see you again and also in person quite soon. Thank you to all. The event will close now in a few seconds.
Bye-bye.
Cheers.
Thank you very much.